Good afternoon, everyone. Thank you for joining us for our webcast on the life cycle of an ESOP. We'll begin in just a moment as others are joining us on the conference line. As I mentioned in the chat window, please feel free to ask questions as we go along through the presentation. If they're on the point, I'll try to address them immediately, and I've also budgeted some time at the end to go over your questions, whatever they may be concerning an ESOP. This presentation is basically geared around giving you some information and some insight into why companies establish an ESOP, what the motivations are during different phases of the ESOP, things you should watch out for, consider in administration of your plan, funding your plan, budgeting for repurchase obligation, etc. And finally, what happens at the end of the ESOP when the ESOP is terminated, either because the board has decided to terminate the plan or because the company's been sold. So feel free to ask your questions as you go along, but we're going to move ahead. We're going to try to keep this inside the 90 minutes and actually closer to an hour than the 90 minutes we budgeted, but we'll keep things moving along. The ESOP life cycle is basically broken down into a few parts. There's the decision to implement the plan, the research that a company goes through or a selling shareholder goes through to find out about ESOPs. Sometimes they find out about ESOPs from their other business advisors. Maybe they're considering sale of the company, talking to a business broker, an accountant, or other trusted advisor about how they can diversify some of their wealth or sell their company. Many ESOPs are family-owned businesses. Say that's the most common structure we see. Most are privately held, and most are in small to medium-sized businesses. So as we go along, we're going to talk about that initial phase, which essentially is exploring the feasibility of implementing an ESOP. We're going to go through different transaction structures, different types of plans, and how the emphasis changes based on the structure. We're going to go through a plan funding phase. It's essentially the period where we're either paying down debt and releasing shares, allocating them to the ESOP participants, or we're putting shares into the plan or purchasing shares with cash we put in the plan. So we're going to look at that from both the leveraged and non-leveraged structure. And we're going to move on to what happens after the debts are paid or the ESOP is funded with the shares it's due to receive. And that essentially revolves around repurchase funding and benefits decisions. And we often refer to that as mature ESOPs. While there's no hard guideline on when an ESOP is mature, we usually use that term to talk about an ESOP that's either been around 10 plus years or is at the end of its leveraged phase. And then, as I mentioned, we're going to talk a little bit about plan termination at the end of the presentation. You can think about these steps as a cycle, a life cycle, just like a product life cycle or a business life cycle. The next slide just takes us through that process. We first go through the feasibility phase. We've decided that we want to put an ESOP in place. We're thinking about a transaction perhaps, about leveraging the company to fund the ESOP, or maybe we're going to not leverage the company and pre-fund our ESOP, or even just put some cash in initially to get a tax deduction while we figure out what the structure is going to be for a transaction maybe a year or two down the road. And we go into that leverage phase, and we're releasing shares and paying down the ESOP debt. Many of you are familiar with that process. Anyone who has an ESOP that's been leveraged has been through that. We're going to talk a little bit about the mechanics, but not spend a lot of time on that today. And then there's the post-funding stage. What happens next? Is there another ESOP transaction for the company? Is that it for the ESOP? Will we go to 100%? Will we stay where we're at? All of those decisions. And then budgeting and planning around repurchase obligation. We're going to talk a lot about that today. So a few common ESOP structures. Pre-fund ESOPs. Initially non-leveraged plans. This is a low-cost way to implement an ESOP. Often there are contributions for a number of years. There's a little bit of debate in the ESOP community about how long you can pre-fund an ESOP. But essentially the idea here is we're putting cash into the plan before the ESOP acquires any of its stock. That cash is building up in the plan with the intention of later using that cash to purchase a block of stock. And that might be 1, 2, 3, even more years, depending on the plan. You have to be a little bit careful on this because ESOPs need to be designed to primarily invest in employer securities. And of course, in the pre-fund stage, there are no employer securities at all. So we do need to have a plan in place for when the ESOP will acquire its shares. Another form of plan that we see is a contribute-as-you-go ESOP, typically a non-leveraged plan. We're going to talk about why some companies do this. The single transaction minority ESOP, or what you might call one and done, this was commonly done for 1042 capital gains deferral in a lot of C corporations years ago. Sometimes that's just to meet a single shareholder's liquidity needs. So you have a single shareholder, maybe a minority shareholder, that wants an exit, but the rest of the shareholders want to remain in place. You might execute a single transaction ESOP. Now, just because you've established the ESOP and did it with a plan for it to be a single transaction event doesn't mean that you can't later do multiple transactions and go to majority, even 100% ESOP. But we're going to talk about when the plan is initially a single transaction minority ESOP, how does that differ from the other more common evolution? And those include multi-transaction majority ESOPs, whether by design or by happenstance, the ESOP acquires blocks of stock in 2 or 3 leveraged transactions. These are sometimes referred to as step transactions. The structure is going away to a great extent because it's so attractive to be a 100% leveraged S-Corp ESOP company for those that can do it, that we're not seeing 2- and 3-step transactions very often. They're more often single transactions or maybe a 2-step transaction to get to 100%. All right, we have a question on share repurchase. I'm going to postpone that for a slide that's coming up where we're going to talk specifically about repurchase and how it can be funded. Quick slide on less common ESOP structures. We're not really going to talk about these, but just for your general knowledge, there are other reasons to implement an ESOP. ESOPs are sometimes a takeover defense for public companies. Sometimes they're a replacement benefit for wage or other retirement benefit concessions, and sometimes in distressed companies. There are a couple of famous public companies that established an ESOP on this basis. United Airlines is an example of this. There are ESOPs that are integrated completely with the 401k plan, essentially a company's stock account within the 401k, usually referred to as KSOPs. There are cases where 401k funds are transferred into an ESOP as part of the funding of the ESOP transaction. And there are occasionally other retirement plans that are later converted to ESOPs. These last two are fairly uncommon, but not unheard of. All right, thinking through the different structures of ESOPs, what are the motivations? These are not mutually exclusive, by the way, but we're going to talk about how each one fits into the different transaction structure. The non-leveraged plan is often done because the company wants to create some employee ownership because that either fits the company's current culture or the intended culture. They want to create employee ownership and employee owners. So sometimes when no current shareholder is ready to sell, you'll sometimes see a non-leveraged plan where newly issued shares are contributed to the ESOP. It dilutes the current shareholders a bit, but it creates a tax deduction for the company, and it's an easy, fairly inexpensive way to get shares into the hands of employees, create employee ownership on a tax advantage basis. The much more common motivation is ESOPs as a liquidity mechanism, a place for current shareholders to sell their shares. So you have a shareholder or a group of minority shareholders or even the majority shareholder. They want to create basically an internal market where they can sell their ESOP or sell their shares to friendly hands, the current employees in the ESOP. This is one reason that ESOPs are very popular in engineering and architectural firms that typically have a culture of employee ownership, particularly among the engineers. Those structures get very complex using traditional methods like stock grants or restricted stock grants or sale of shares that have some bad tax implications. An ESOP can get the same result on a more tax advantaged and less complicated basis. By far, the most common motivation for establishing an ESOP is a single liquidity event. You have a retiring shareholder that either wants to do it in a single transaction or wants to sell to the ESOP over several step transactions. And now we're seeing a new motivation, even when the selling shareholder or the current shareholders are not looking to sell at the moment. They see the tremendous tax advantages of being a 100% S-Corp ESOP, and they're considering converting their equity into an ESOP with some synthetic equity structure just to realize the great tax benefits of being a 100% S-Corp ESOP. And in some companies, that works really well. We see this in growing companies or companies that haven't quite matured as a structure early on in the company's life, that we're establishing an ESOP and making it a 100% ESOP, getting benefits to the current shareholders through the ESOP and through grants of synthetic equity. When I use that term synthetic equity, I'm talking about non-qualified deferred compensation, synthetic forms of equity. And they can be stock appreciation rights, phantom stock rights, options, warrants. There are a whole variety of things that constitute synthetic equity. We'll talk about those a little bit more as we go on through the S-Corp structure. So in the funding phase, the most common structure, the leveraged plan, usually a minority transaction is happening in a C corporation. It can happen in an S, but more often we see in an S that companies are going directly to 100%, particularly in the current credit environment. So minority transactions traditionally have been C corporations for the most part. The primary motivations are for the seller taking capital gains deferral under Section 1042. Although with lower capital gains rates these days, we see less and less of that election. People are willing to pay the 15% and move on or take installment sales treatment. For the company, the tax shield created by contributions to the ESOP and removing the leverage added by the ESOP transaction are usually the primary motivators. So typically in minority transactions, particularly in C corporations, management and the board will often want to accelerate the ESOP debt repayment, and they'll want to get matching tax deductions. So often the company pays down both its external debt to the bank or selling shareholder and its internal debt between the company and the trust quite quickly, seeking to maximize the tax shelter and to match the cash outflows leaving the company. There's nothing wrong with that approach. I will say that a lot of C corporation minority transaction deals often lament the fact later that they accelerated payments, even though that might have made a good business decision considering the tax benefits and the effect on the cash flows of the company. From a benefits perspective, coming to the end of that 5, 10, 15-year period of paying it down early, when there's not a plan in place for what happens next, you often create what's referred to in the ESOP world as a have-have-not situation. So that's the pitfall that we're going to discuss in that type of transaction. But understand that the motivation to pay down the debt quickly makes sense from the corporate finance perspective. It may not make sense from the employee benefits perspective. Multi-stage transactions are usually planned ahead. We have a timeline in the feasibility structure. We've considered, when the company can have its debt fully repaid and when the company can be ready for its next transaction. So often you'll refer to these as ESOP 1, ESOP 2, ESOP Loan 1, ESOP Loan 2, etc. They have a time frame in mind. You might be doing a transaction with a seller that's several years from retirement age in the first transaction with a plan to execute the second transaction at their retirement date. In between these first and second transactions, the motivations are similar to the minority transaction. We want to pay down the debt quickly because paying down the debt negates the effect of the debt on the company's value. So if we're doing a second transaction, we want the first loan fully repaid before we do the second transaction so the value is not impaired for the selling shareholder in the second transaction. So again, we're focused on servicing the debt, taking the tax deductions, mainly because of the impact on our ability to do the second transaction and the price at which that second transaction would occur. And then in majority transaction, in this case, we're talking about going, to a substantial majority, usually in one shot. And this is very popular for S corporation transactions these days, where we may be going from 20 or 30% in an initial transaction up to 100, or even from 0 to 100% in one transaction. And as you could imagine, the substantial debt load that this type of transaction creates makes servicing that debt very crucial for the company, both because that debt impairs the company's ability to fund capital expenditures and fund growth, and because with this type of structure, we're usually granting some synthetic equity either to the selling shareholders or to management, sometimes both. And the repayment of the debt enhances the value of those synthetic equity tools. So management's motivated to enhance its value by paying down the debt, appropriately rewarded because the debt represents a substantial risk for the company. And the selling shareholder may be rewarded for the financing of the transaction. Usually, a 100% transaction involves some type of seller financing. Most companies could not raise the senior debt needed to do a 100% transaction. So the cases for 100% transactions range from seller financing for the complete transaction, the entire amount of debt involved, to taking some senior debt, seller receiving some cash at closing, and then taking a subordinate note for the remainder. For non-leveraged plans, the funding phase is a bit different. We're not paying down debt. We're not releasing shares based on the debt repayments. Instead, we're putting either cash or shares directly into the plan. And the motivations there are usually the tax deduction that's created and or the employee benefit created by each contribution. And essentially, we're fitting those contributions into a transaction plan or timeline. We usually have in mind a percentage that we'd like to see the ESOP own. In fact, SES Advisors has an ESOP, and this is really our approach in our ESOP. We're funding the ESOP. We have an intention to grow the ESOP's ownership of the company, and we're funding that through non-leveraged contributions over the years. So the ESOP now represents almost 9% of SES's holdings. The other 91% are owned by other employee shareholders of SES. And this is sometimes done as a pre-fund, as I mentioned earlier. Usually there are cash contributions in that case with the intention of using that cash to purchase shares at some future date, perhaps in a leveraged transaction, and the other contribute as we go. This is a lower cost way of funding the ESOP. You can adjust the stock contributions from year to year depending on your need for a tax deduction and depending on the kind of performance the company had that year. This is an ESOP much more as a traditional retirement benefits form. So the ESOP in this case works much more like a 401k or profit sharing plan in terms of the decision to fund the plan from year to year. All right, so how does an ESOP and a structure impact corporate governance for ESOP companies? Well, in non-leveraged or minority ESOPs, there's usually very little impact on corporate governance. Generally, the only thing we'll consider is whether we're going to pass through voting rights on issues not required by ERISA. So ERISA requires a pass-through vote in certain corporate transactions involving a merger of the company, a sale of substantially all the assets of the company, a recapitalization, and a few other items that generally happen rarely in your typical corporation. But there's nothing saying that you can't pass through voting rights on other issues that require a shareholder vote. And typically, we see, at least in a minority of ESOPs, pass-through votes on things like the board of directors in some cases. Again, that's a unilateral decision by the board of the ESOP sponsor. It's not required, but it's something that some ESOP companies decide to do. If they're not passing through the vote, then other than a sale of the company or a restructuring merger of the company or a sale of substantial assets, there's almost no impact on the company's corporate governance for a minority ESOP. In majority ESOPs, the same rules apply, but we more typically see an effort to create more representation for the ESOP and the ESOP trustees in the company's corporate governance structure. We often see that company looking to outside board members much more often than traditional family-run, privately held business. There's usually some consideration to how the board slate will be nominated. And this can range from the board proposing a slate for an up or down vote by the ESOP trustee. You may consider passing through the vote in those cases, but obviously the trustee is much more involved because even if you're not passing through the vote, the trustee is voting the shares on behalf of the ESOP participants. So there's usually some more representation, some more involvement by the trustee in the corporate governance of the business when it's majority ESOP. And then it's very important in majority ESOPs, particularly if you're redeeming stock each year, if the ESOP's ownership percentage is shrinking because of your repurchase funding decisions, you have to pay attention to the point where the ESOP will reach a level of change in control. So if you did a 51% ESOP one day, and then down the road it made sense to redeem some of that stock, you need to pay attention, and trustees need to pay attention when you come to the point where the ESOP is going to drop below a controlling interest. The trustees generally should try to intervene just like any majority shareholder would when they stood to lose a controlling interest in the company. That's important for valuation and corporate governance issues. So I'm not going to spend a lot of time on plan administration today, but we need to define a few things that define some limitations on what we can do in our repurchase and benefit funding decisions. And a big component of this are the IRS compliance limits. And those of you who have an ESOP probably are familiar with these limitations, at least familiar with seeing them on the report, or perhaps talking to your plan administrator about what they are and what they mean. So real quickly, there's a limit on the deductibility of contributions. That's under Section 404 of the Internal Revenue Code. And generally, this is 25% of eligible compensation for S corporations, and that includes principal and interest payments, contributions to fund repurchase, and contributions to other retirement plans like a matching contribution or 401k profit sharing contribution. In a C corporation, it's very similar, but the interest is separately deductible under the 25% limit. There is a separate 25% limit for C corporations concerning repayment of its debt. But bottom line here, whether you're a C corporation or even 100% S corporation paying no taxes, you do have to pay attention to these limitations because exceeding them triggers an excise tax. So 404 places some limits on how much we can fund into the ESOP in any given year, which makes pre-planning on your repurchase obligation crucial in some cases because repurchase obligations tend to be lumpy. You may have some very large account balances retiring the same year. So you need to be thinking about these limitations in the context of planning around your repurchase obligation. 415 is the same kind of limit, but it applies to individual participants' retirement plan contribution limits. It's $49,000 right now. It's composed of elective deferrals in the 401k, matching contributions in 401k, other retirement benefit contributions, and ESOP contributions. So all of those added together need to be less than $49,000 for an individual participant. In some cases, we're counting forfeitures in that number and interest payments on the ESOP debt. 404K applies to deductibility of dividends in a C corporation. 4975 F7 is a similar provision applying to S corporations for earnings distributions. A few things to keep in mind here. If you're using dividend funding or earnings distributions to pay down debt or to even fund repurchase obligation, you have to be careful about the reasonableness of the dividends. There are some general guidelines, but no bright line on what is a reasonable dividend. You need to be cognizant of the effect of using dividends to pay debt and some special tests that we have to pass. That's very important in particularly a single-stage 0 to 100% ESOP transaction, because one of those tests looks at the fair market value of the shares we're allocating to our participants, and in that type of structure, with all the leverage taken on in the transaction, the dividends, the value of the shares released by dividends is substantially deflated by the debt. So that requires a lot of careful planning in your funding stage for an ESOP that's gone from 0 to 100% in an S Corp, and even in majority transactions for C corporations or second stage transactions. And finally, 409P, applying only to S corporation ESOPs, looks at the concentration of benefits in the ESOP. Basically, what we're looking for here is participants in the ESOP owning more than 10% of all of the ESOP shares, allocated and unallocated, and synthetic equity tools, those other options, benefits that represent economic value connected to equity, any individual owning more than 10% individually, or family group broadly defined owning 20% or more. So this is particularly important for smaller ESOP companies. You need to ensure that you don't have these concentrations exceeded. Those who have more than 10 or 20% respectively cannot collectively own more than 50% of the company. If you fail this test, you have a very severe excise tax on both synthetic equity and whatever benefits have been allocated to these people. We have a question before we move to the next slide on forfeitures and the 415 limit. I alluded to forfeitures and interest sometimes counting in the 415 limit. This applies only to C corporations. 415C6 allows us to exclude forfeitures and interest, provided that our allocations to highly compensated employees represent less than a third of all the allocations to employees. So if we're allocating less than 1/3 of the benefits to highly compensated employees, we may exclude in C corporations shares reallocated as a result of forfeitures or cash reallocated as a result of forfeitures in the ESOP, and shares released by contributions to pay interest. In S corporations, these shares are always included in the 415 test. All right, so a question we often hear, the loan's paid off, what's next? And sometimes we hear this from someone coming in at the very end of the ESOP leveraged phase, and they're learning about the ESOP, and they're learning that, wow, I came to the party a little late. What's going to happen with the ESOP now? How am I going to benefit from this? Or how are our new employees going to benefit from this now that we're going to drop our contribution rate so dramatically? So the answer to this question depends on the circumstances of the company. So the first thing we want to do is think about what happens next for the ESOP and for the company. And we've got a variety of answers to this question. The answers often depend on the reason for establishing the ESOP in the first place. So I'll start with probably the least common, but certainly a number of our clients have done ESOP transactions solely to accommodate the sale of a shareholder's stock. They didn't do it for cultural reasons. They didn't do it to create employee ownership. They did it to purchase a shareholder's shares, either because, frankly, the company wanted to see the exit of that shareholder or other shareholders did, or because they wanted to accommodate a shareholder's wishes and they wanted to do it on a tax-advantaged basis, and perhaps none of the other shareholders were looking to making another capital contribution and acquire those shares directly. So in those cases where it's a singular liquidity transaction, we sometimes see the ESOP sort of go dormant. Contributions drop to zero initially after the repurchase or the funding the leverage phase. We paid off the debt, contributions go to zero. Management says, wow, we've gotten through the debt repayment, that's great. We're going to go back to contributing to the 401k, the matching contributions or profit sharing. Our people generally don't understand the ESOP. You know, it's nice to get a benefit statement, but we don't have any plans. No other shareholder is looking to sell any stock. We have no plans for the ESOP beyond repayment of this debt. That can be a fine answer. There certainly is sound reasoning for that structure and that approach. What we'd recommend, if that's the case, is that you freeze the plan. The reason for freezing right after the debt's been repaid is to not create this two classes of employee structure. I mean, in a sense you are, but I'll explain the nuance in a moment. If we freeze the plan, all of the participants go to 100% vested. but shares stop moving around within the plan. Future benefit statements are just going to be the shares that were in the account the year before. You're not going to see shares moving in or out of the accounts, except when someone is paid out their benefit at retirement or after termination. And often those are done as stock redemption transactions or distribution of the stock in kind. So essentially what happens is the plan is frozen, the shares aren't moving around, the shares are being repurchased every year, and the ESOP is slowly shrinking. The benefit to that structure is that we don't create a situation where you have an employee meeting or you distribute your benefit statements for the ESOP, and you have the phenomenon where if we didn't freeze the plan, you have a block of new employees that are receiving benefit statements with tiny benefit amounts. And why are there tiny benefit amounts? Well, you have forfeitures that are being reallocated, recirculated through the plan. So if you freeze, you essentially have two groups of employees, those that were there during the ESOP period and those that came after. As long as you're communicating that message, it's actually a better message than handing out these meager benefit statements. And also there's some additional administrative complexity and cost to having all those new participants enter receiving only very nominal benefits. So if that's the answer for your plan, you want to be considering freezing the plan after termination. If things change, if down the road, 10, 15 years even, the ESOP is still around and a shareholder wants to do a transaction, the frozen plan can be unfrozen by board action. So you can go right back to the leverage mode, doing another sale to the ESOP and reallocating shares or releasing shares as that debt's repaid. So a frozen plan can be unfrozen at any time in the future. For some companies, and this is more common, the plan is to consider the next transaction. When will it occur? When will we go to majority ESOP or even 100% ESOP? And so in the interim, you want to think about, well, do we start thinking about repurchase obligation and funding the plan because the next transaction is quite far down the road? Or maybe it's a few years down the road, we consider using that pre-fund technique. We continue to make employer contributions during the interim phase. They're cash contributions generally, and then we build that cash up for part of the funding for the second stage transaction. So if that's the answer, then new employees are going to receive cash allocations in the ESOP, and you can use one of a few funding mechanisms or repurchase mechanisms to start getting shares into those accounts to replace that cash. And we'll talk about that in a moment. So if the plan is to generally just make a market in ESOP shares as other shareholders exit, well, then you might consider a modest contribution just to create some benefits in the ESOP and a more significant contribution at the time you know that a shareholder is looking to exit. So if it's a little bit up in the air based on what shareholders are looking for, you recommend at least doing a nominal ESOP contribution of cash or newly issued shares and waiting to see how that develops when the next shareholder is looking to exit. When that is known, then you can go into a pre-fund strategy or a leverage transaction at that point. All right, so in cases where you don't have a plan to acquire stock in the near future, but you've gone to majority ESOP or you particularly have a lot of stock in the ESOP, you want to be thinking about funding repurchase obligations. So the debt is repaid, we can take a breather a little bit, we can drop the contribution rate, but we want to be thinking about the level of funding necessary to meet our future repurchase obligation. And that could be, we're just going to pay into the ESOP as we go, whatever our repurchase obligation need is from year to year. That strategy can work in some companies, particularly where the company is large enough that the repurchase obligation is spread out rather smoothly. So that can be a viable option. We're going to talk more about that in detail in the next few slides. We can think about a re-leverage transaction where essentially we buy back a block of stock on a leveraged basis as the ESOP. We first redeem some stock and then we buy it back with leverage, and we're going to go through a detailed example on that. So for repurchase obligation funding, a few tools here. These are fairly complicated tools. We're not going to spend a lot of time going through them just in the interest of the overall time budget. But the most common is recycling. Recycling is a cash contribution into the trust in order to pay benefits to a terminated participant, and in exchange for that contribution of cash, we're going to repurchase the shares within the ESOP trust. So we get a deduction for the cash contribution. That cash is exchanged for the terminated participant stock. That stock gets reallocated to active employees. When your repurchase obligation is small, this is a very simple, efficient, not very complex option, and it's by far the most popular option, particularly in early stages. Redemption transaction is a stock redemption like with any other shareholder where the company is repurchasing the stock, either because that stock's been distributed from the ESOP trust or because the company and the trust have entered into a redemption agreement. But basically, we're taking those shares out of the ESOP in a redemption transaction. Most commonly, redemption is used when a repurchase obligation in a given year is larger than would be appropriate with funding within the ESOP. So you have a down year in the company, but you find yourself with a large repurchase obligation. You had somebody retire with $1 million balance, and wow, we contributed $500,000 to the ESOP last year. Now we find ourselves in a down year with a $1.2 million repurchase obligation. We don't want to fund $1.2 million into the trust. We want our benefits to be aligned with our performance. We want to think about this like a profit-sharing contribution. In those cases, you're not obligated to put the full $1.2 million in. You could decide to put $300,000 in because we've had a subpar year. The way you get the rest of those shares out to meet your repurchase obligation would typically be either through a redemption transaction or a redemption followed by a re-leverage transaction. So there are ways to smooth out your repurchase obligation using one of these two techniques. So you're just not obligated to follow the recycle strategy. If you follow the recycle strategy in a company with a lot of ESOP ownership, you generally will find that from an employee benefits perspective, it's very inconsistent with how you would fund a normal retirement plan. That may bother some companies, it may not bother others, but just understand that repurchase obligations generally are not very smooth, and so your benefit allocations are often going to seem inconsistent with how you would fund a traditional retirement plan. I mentioned that if we're doing some cash funding, after we've repaid the debt and we want to convert that cash contribution in order to get some shares in participant accounts, we can use one of a couple techniques. Well, first off, if there are shares to be repurchased, we can do recycling. So that converts the cash to share allocations. We can accelerate that by adopting a reshuffling provision or a segregation provision. And basically, segregation means is that before the terminated participant is eligible to receive benefits under the plan, you go ahead and convert some or all of that person's account to cash, other investments. So it's a segregation provision. It's basically dependent on the ESOP trust having some cash, and then depending on the plan document, a decision to go ahead and segregate accounts. If you don't like the idea of a terminated employee benefiting from the rise in your stock price, segregation is attractive, or if you want to get benefits in the form of shares to your new employees, segregation can accelerate that. Segregation and rebalancing are topics that we've done full webcasts on, so these are complicated concepts. but popular options for mature ESOPs. The rebalancing provision is similar to segregation, except that instead of targeting terminated account balances, we're doing an exchange within the ESOP trust, cash for stock of equal value, such that everyone at the end of the day, at the end of the plan year, holds the same percentage of company stock and other assets. So what we do administratively, we go through the whole process, allocating earnings, contributions, repurchases, everything that happens in a typical plan year. And at the last step, we're doing an exchange that doesn't change the participant's account balance, but does result in an exchange of equal value cash and stock so that every participant holds the same percentage of each. Earlier there was a question about repurchase obligation and funding it with a note from the company. This is an option. I want to talk a little bit about your options for distributing first. You have a distribution policy as mentioned on the bottom of the slide. That distribution policy typically is designed to be as conservative as possible under the laws, under ERISA, from the outset. It usually calls for a 5-year wait for benefits, and it usually calls for payments over 5 years. There are exceptions for retirement, death, and disability, but for the most part, normal terminations are going to wait 5 years and then be paid out over 5 years. There's also a decision in your distribution policy as to whether to distribute cash exclusively if you're an S Corp or a C Corporation with a restriction in your bylaws, or to just make it discretionary to the participant, or to distribute exclusively in stock. There are some ESOPs and a lot of older ESOPs where the decision was made, we're going to distribute stock and we're going to take advantage of a provision in the code to pay for that stock with a 5-year note. There is a provision in the code for a payment with debt. So we've distributed our stock in a lump sum. The participant has sold that stock back to the company, and the company has decided to pay that debt with a 5-year note. Perfectly acceptable. It's defined in the code, but there are a few practical problems with that approach. First off, from a taxation standpoint for the participant, the cost basis of the shares is taxable as ordinary income in the year that they receive the stock. The gain is taxable as capital gains in the year they exercise their put option, which is really a long-winded way of saying they're going to have a big tax bill in year 1. So even in a 5-year note structure, while you're able to spread it out over 5 years, you typically want to advance at least enough cash to let the participant meet their tax obligation in year 1. The second problem, and this is a much more significant problem, is that these notes have to be adequately secured. And years ago, there were bonding companies that would sell you a product, a line of credit, etc., that would provide adequate security. Those have gone away in the last 5 or 7 years. You generally can't buy those products. So instead, we have to meet a very high standard with regard to adequate security. And when I say a high standard, generally that means we need first lien on behalf of these ESOP participants on otherwise unencumbered assets. So we need to have something that we can provide as collateral to the ESOP participants, and we need to perfect a security interest in those assets. So unless your bank is willing to provide subordination, or you have some assets that are otherwise not encumbered by your line of credit or other obligations of the company, it can be very difficult to establish adequate security for paying with promissory notes. And that's exactly why I mentioned, I've got caution in brackets here. This can be done, but you need to be very cautious about the structure, because failing to get any part of it right results in a prohibited transaction and some significant excise taxes. There's another question about note payments involving an S corporation. Stock must be converted to cash. We also wish to recycle shares. Can we pay with a note by the ESOP? The ESOP can't pay with a note itself. That's a prohibited transaction. As an S Corp, if you distribute the stock, you can make that distribution contingent on an immediate conversion to cash. So you can make it such that the stock is immediately converted to cash, which is what most S corporations want to do. They don't want to have a nuisance shareholder. They want to keep the shareholders under 75. They don't want a prohibited S Corp shareholder like an IRA. So they typically make the distribution of stock contingent on an immediate sale of that stock. You can still go through the note payment process in that, but it needs to be a note from the company in that situation. If you want to recycle shares in that structure, you have a couple of options. The first option is simply don't distribute the stock. You're an S corporation, so you don't have to distribute stock in kind. So if your intention is to recycle, then a very easy way to do it is to put cash in the plan for the purpose of recycling those shares and never distribute the stock, which you're permitted to do as an S corporation. You're not required to distribute the stock as an S corp. All right, so I'm going to move on. A couple other issues that affect how repurchase obligation is funded. The decision to make contributions to the plan, the decisions to make dividends or earnings, and your distribution policy itself. The policy within the plan that defines when and how a participant is paid. All very important in considering repurchase obligation. So all these mechanisms are rather complicated and even convoluted. Why do we worry about this? Why not just pay as we go? Well, the answer is you can have several issues. You can have fairness issues concerning the benefit allocations among ESOP participants. And here I'm referring to the fact that the allocation will go up and down depending on the repurchase that year. That's not really consistent with employee performance or company performance, and so you can get some erratic benefit allocations. Relative fairness issues for non-ESOP shareholders. So, for instance, if you have to turn to dividend funding because your repurchase obligation exceeds the limitations for employer contributions, if your articles allow it, you can make a dividend payment to avoid that problem. But then you have fairness issues for the non-ESOP shareholders. Is this appropriate compensation level for your ESOP participants, and what do you need to do, if anything, for your non-ESOP shareholders? And then there's the total cost of the repurchase obligation. Using a recycling strategy versus some of these other mechanisms can increase the cost of your repurchase obligation funding, which of course has an impact on the capital reserves of the company and, in the end, the value of the company. Repurchase studies. So when do we begin repurchase studies? In some cases, we begin at the very outset in the feasibility stage. We particularly do this for majority ESOPs, which are often highly leveraged. So if we're going from 0 to 100% S Corp, we're doing this often before the ESOP is ever adopted and the transaction structure is, or the transaction is executed. We're doing it in the planning phase because it's going to be very important that we can service the debt and meet the repurchase obligation, and that those cash outflows fit within the capital budget of the company, and we don't have repurchase obligation too early while we're still paying off this significant debt. More typically, we begin the repurchase studies after the debt funding phase. And this might be the initial if it's a single transaction, or after the last loan in a multi-step transaction. But basically at the point where the ESOP has acquired substantial shares, we think about doing a repurchase study in those circumstances. And the importance of the study can range from incidental, even unnecessary in some cases, to critical, depending on the structure. So on this slide, this may be a little hard to read, but anybody who wants the deck, you'll see this in a little more detail. We'll be happy to get it to you. The company factors over here on the left are the ratio of value to our payroll. So if we have high company value and a relatively small payroll, that's a factor that we need to consider. And the higher the ratio there, the more important it is to plan for repurchase obligation. Why? Because two factors. One, the low payroll relative to a company value means that the limitations for contributions and so forth are going to be a big factor in how we fund the ESOP and what tools we need to use to fund the ESOP. And two, the value itself, high value to payroll, will generally mean you're going to have a lumpier repurchase obligation, which is, in essence, what the next column suggests, the value per employee. We have a relatively small company or a company with a lot of value per employee, just because perhaps personnel costs are just a low percentage of the company's overall cost structure, or we've got a company that is relatively small, growing. You can have a high value per employee, and if we have that result, our repurchase obligation is going to be less predictable, more lumpy, and we're going to bump up against the limits again in many cases. And the third factor is just how leveraged the company is overall. We might be highly leveraged because we're still paying the ESOP debt, or we might be leveraged because of other working capital needs, other growth opportunities for the company. But the more leveraged we are, the more we have to plan for repurchase obligation. So in the lower left hand, I wouldn't call this a quadrant because I don't view it as a quadrant, but for ESOP companies that are, say, 30, 35%, and they don't have the volatility in their value structure and payroll structure, in this lower quarter or sixth, whatever it is, you might say that repurchase obligation is incidental to operation of the company. You probably want to spend a little time thinking about it and perhaps doing your own 5-year forecast just to have an idea about the repurchase obligation bill that's going to come along. But in this area, minority ESOP with fairly large employee base representing a fairly low ratio of value to payroll, we don't have to worry too much that this is going to create any serious problems for the company. On the other hand, even in minority ESOPs, where you have a lot of leverage or a small employee base or a high value to payroll ratio, we want to carefully consider repurchase obligation because we can have some surprises and undesirable consequences if we don't plan ahead for the repurchase obligation outflows. Over in the lower right-hand corner, with relatively low value to payroll, but a majority ESOP structure, I want to think about repurchase funding mainly for what it does to allocation of employee benefits and relative fairness. So you want to spend some time and think about your benefit funding decisions if you're in that area of the chart. In the upper right-hand corner, high leverage, high value to payroll, high value per employee. With the majority ESOP, it's absolutely critical to spend time in repurchase obligation planning. And when I say critical, we mean critical in terms of sustainability of the company in the long run. If you're in this area and you don't pay attention to repurchase obligation, you're going to have more than just benefit problems. You're going to have capital budgeting problems that can undermine the company's sustainability. So very critical in that quadrant. We have a question, can we explain high value to payroll versus low value to payroll, and an example. All right, so value to payroll, I would say if your company value is less than 4 or 5 times your payroll, I would put you in the lower half of that chart. At 8 or 10 times, you're at the top of that chart. Commonly, ESOP companies are going to be somewhere around 5 to 8 times, particularly for majority ESOPs, depending on if you're a service company or a manufacturer, etc. But the higher your ratio of company value to your payroll, the less flexibility you have within the compliance limits to meet a repurchase obligation need, and also the more lumpy your repurchase obligation is going to be, and the more you need to plan for it. The value per employee, it's basically the size, but it's also a function of value. So if you have large account balances in your ESOP per employee, those often become self-evident as the ESOP matures, and you look at the allocation reports and you see the people that are nearing retirement age. If you have high-value accounts per employee, you want to consider things like insurance funding or pre-funding for that obligation. So how should we plan for the repurchase obligation? Well, I would start with understanding your contribution. This chart, a little bit hard to read here in terms of size, but on the left-hand side where we've got the purple and burgundy column, this company, before an ESOP, pre-ESOP, was funding into its 401k plan a matching contribution representing about 2.5%, and a profit-sharing contribution in a decent year of another 7.5%. So the total retirement plan contributions before the ESOP was adopted were around 10% in total. Often, if you go into pre-funding an ESOP, you might leave the match in place, but then start making more significant contributions to the ESOP. In this case, the company added 10% on top of the match to do some pre-funding of the ESOP transaction. When we got into the debt repayment phase, the contributions went up to as much as 20% of eligible payroll. So we're now making a contribution that's much greater, double what we were making before the ESOP was implemented. But we're looking to maximize tax deductions in this phase and to get the ESOP benefits allocated and to take as much advantage of the tax shelter as we can, particularly while we're paying out this large amount of cash as debt payments. After the debt's repaid, we often go back to a more traditional contribution for retirement funding. In this case, we've dropped the profit-sharing component of 401k, but we started putting some cash back into the 401k as profit-sharing. We've decided to go back to 10% from a retirement funding standpoint. This is essentially what we would do if the ESOP didn't exist to our retirement plans. But in this case, we've spread it through the 401k and ESOP about equally, about 5% each. This gray area on the top of the last bar is additional funding that we need. And it's funding that we need to meet our repurchase obligation. So understanding that, building that up, in this case, we're putting 17% into our retirement plans in total, but we would, all of the things being equal, put in 10% in total. So we've got an additional 7% that's needed to fund our repurchase obligation. Why does this matter? Well, that last part, if we have other shareholders, we want to consider, that we're making this additional ESOP contribution or dividend payment for the purpose of meeting repurchase obligation to meet essentially what is a shareholder liquidity event. It happens to be a ESOP participant liquidity event, but you can think about it in the same terms of we need to use some of the company resources to create liquidity for our shareholders. So if you understand your funding from the bottom up, you can put the additional funding need into its proper context when we go through the other issues. So if we have other shareholders, if we're not 100% ESOP, we have to ask ourselves, is this level of funding appropriate compensation? Just as the ESOP trustee would need to ask, is management's compensation reasonable? You can ask the same question about the ESOP and the ESOP participants, the employees. Is the level of funding we need to put into the ESOP appropriate compensation? If it is, that's fine. That's a fine result, and often that's the conclusion. But if it's not, we need to consider other tools such as redemptions or dividend funding. The dividend funding and redemptions have a neutral effect on the other ESOP shareholders and the value of their stock. So those are options when we don't want to fund that gray area from the prior chart with employer contributions because it would be inappropriate compensation. So we can use dividend funding as long as the non-ESOP shareholders are sharing in those dividends to fund that gray part of the bar. Or we can redeem those shares. We can take them out of the trust. And because of the cancellation of those shares, the value proposition is neutral, at least in the short run, for non-ESOP shareholders. The other questions we need to ask are, what are the employee benefit priorities? Are we looking to provide shares for new employees? Or are we also interested or instead interested in providing some diversification for long-term employees? Those two ideas are actually compatible, and we might adopt a segregation or rebalancing strategy to meet both those obligations. Obviously, an ESOP is a non-diversified retirement benefit. It's probably the biggest limitation on the value of an ESOP is that it's solely wrapped up in employer securities and therefore less diversified, a little more risky than other forms of retirement benefits. Providing diversification for your long-term employees can be a really good outcome or goal, and providing that diversification by moving some shares out of their accounts can be good for new employees. Now, if your stock is appreciating significantly, the long-term employees may not view that diversification as beneficial. But if you communicate it that way and it's part of the plan policy, the next time there's a drop in the stock price, they're going to view it the way that we're intending here, that they've got some diversification. So it's something you need to communicate to your employees if you want to follow that path, but that can be a fine outcome for your long-term employees and your new employees. So what are the company's finance priorities? Are the tax implications the most important? Often not if we're S Corp by this point. Tax implications are incidental or not important at all. Are we most interested in smoothing out the cash outflows that are created by repurchase obligation? Are we planning for contingencies? We have large account balances in a few ESOP account holders' accounts. Do we want to consider contingency in the event of the death of one of those participants? Or are we just worried about managing the size of the obligation or company value? Often we're managing all of these priorities, and this last priority is often a very important one, and one that changes depending on the tools you use to finance the repurchase obligation. So how often should we look at it? And what assets, how should we designate assets, or how should we handle the assets that are going to be used for future repurchase obligations? I would recommend that you do a planning cycle with a 5-year plan that I would look at least annually. It doesn't have to be that complex or detailed. In fact, you can probably do it in-house. You can ask your TPA. SES does these short-range forecasts. They're mostly dependent on very known factors: employee demographics, the age of your employee population, and the termination date for your terminated vested participants. So we know a lot of what goes into creating a 5-year forecast. Those short-range forecasts are much less dependent on employee turnover, general demographics. That's where you get into a repurchase study, and there are several options there. There's a very good ESOP Economics, a company we work with very closely in Philadelphia. Many of you know, definitely experts in repurchase obligation forecasts, particularly the longer range forecasts. Definitely recommend that you consider doing a study periodically. So that 10-year plan, looking out on a 10-year horizon, is something you ought to look at least every 5 years. More often, if you're a 100% S-Corp ESOP company, you might look at that every 3 years. But you want to be looking at what's immediately in front of you and any surprises that could be 10 years down the road for the company in terms of repurchase obligation. And of course, these timelines are highly dependent on the percentage of the company that the ESOP owns. So if ESOP owns a small percentage, it's less important to look at these things. You can look at it on a longer time horizon because you're not going to be hit with a surprise that's going to impact how the company operates if it's a small percentage. So factor all of those things into your planning, but do think about repurchase obligation planning and doing a repurchase obligation study. So options for funding. We've looked at the repurchase obligation. We have a forecast, or we have the study results. How should we fund it? One common structure is to create a sinking fund on the balance sheet. This is informal. It's not a legal structure. It's not something that the company is bound to, but you can create a designated fund, an investment fund on your balance sheet for the purpose of funding future repurchase obligations. In a company emergency, or if a business opportunity arises that demands that the company or suggests that the company ought to tap into that fund, it can. It's not contributed to the ESOP trust. It doesn't belong to the ESOP trust directly until contributed. So that's one of the benefits. You have more flexibility in this type of arrangement. One of the downsides is that that excess cash will find its way into your company valuation, almost by definition, because it's money that we're setting aside in excess of our working capital budget for the purpose of funding future repurchase obligations. So by definition, it's cash in excess of working capital needs, and if your valuation firm is using a discounted cash flow approach or capitalized earnings approach, this will almost always find its way into your company valuation, which in the end means that some of the cash set aside to fund repurchase obligation ends up increasing the cost of repurchase obligation. The other option that's fairly common is putting the cash into the ESOP trust. The benefits and negatives are generally the converse of what we just discussed. One benefit is it provides diversification to ESOP participants. It creates a pool of assets that are protected from creditors, and it doesn't increase the company value. So that value has gone down to the trust. It's still there, available for repurchase obligation, but it doesn't go into the company valuation. The downside to this approach is that some of that cash that we're intending to use for repurchase obligation is going to end up leaving the trust as direct cash payments to the employees that terminate. So if we're intending to set all that repurchase obligation cash aside for the purpose of repurchasing shares, if we drop it down to the trust, some of that is going to leave as cash, and we're not going to have 100% of what we funded available to repurchase shares. I think the bottom line on these two approaches depends on the benefit allocation question. Is the contribution and funding you're putting into the trust appropriate? So if you're already funding an appropriate retirement plan and liquidity need contribution for the ESOP, I wouldn't necessarily consider bumping the contributions to the maximum limits or paying large dividends solely for the purpose of getting that cash down to the ESOP trust. To the extent I had excess funds needed for repurchase obligation, I'd consider leaving them on the balance sheet. So I'd employ both approaches depending on what you need. We have a question about sinking funds. Is there any way to mitigate the effect of excess cash on share price? If we are doing purchase obligation forecasting that shows we'll have this obligation in the future, the answer to that question is it you should talk to your appraiser about it. If the appraiser is of the school that believes that repurchase obligations ought to be factored into the valuation, then that might be a perfectly appropriate adjustment to the valuation price. And in that case, the sinking fund will not increase the cost by increasing the value of the company. Not all appraisers are of the same school of thought on this, because ERISA, the only regulations ever created regarding valuation, instructs the appraiser to look at it the way a third-party buyer would look at it. And the third-party buyer would consider the excess cash on the balance sheet. They wouldn't consider the repurchase obligation need, because upon purchase of the company, the ESOP obligation, the repurchase obligation goes away. So a third-party buyer wouldn't look at it in terms of the value of the company, and the appraiser is generally instructed to do exactly what a third-party buyer would do. There are many appraisers that have a pragmatic view of it, and of course, repurchase obligation is a real cash demand for the company, and therefore, if we're going to have a sustainable ESOP company, one ought to factor those cash demands in the valuation. If you do happen to have an appraiser that doesn't fall into that camp, there are mechanisms, including releveraging transactions, that force that issue. So we've got about 13 minutes left. I'm going to go through a couple of these slides quickly so we can leave some time for questions. In some cases, with accounts or with small companies or companies where there's a concentration of ESOP accounts with very large balances, it may be tax efficient and effective to use insurance funding. The downside of this is it can be expensive, may not have the right results if you don't structure it properly. So you have to be careful about who the beneficiary is and who holds the policy, but insurance funding can be desirable. Serial releveraging is an approach where you basically simplify this whole process by pre-funding 5, 7, or 10 years of repurchase obligation through a releveraged transaction. So the benefits are you lock in the price essentially, gives the board a lot more control over benefit funding decisions. You can smooth that all out, and you can reduce the cost of repurchase obligation because the debt incurred in the obligation or the excess cash used to fund the releveraged transaction, whichever the case may be, will have an impact on valuation, an impact that basically forces the appraiser to consider the cost of repurchase obligation because, in essence, from their perspective, the money has been spent ahead of time, frankly. This carries some transaction costs and complexity. It can raise some fiduciary concerns, something you definitely need the trustee to look at carefully. And if it's structured too long or too great, it can be unfair to long-term participants. So there are things you want to consider in terms of protections to those participants and the impact on those participants. I've included 2 studies in the deck. I'm just going to briefly go through them. I'm not going to go through all the facts. One company came to us, asked us to look at repurchase funding mechanisms. We looked at a whole bunch of hybrid arrangements, all recycling, all redemption, all releveraging, and combinations thereof, and came up with a plan that over the next 10 years would reduce repurchase obligation by $1.5 million using a combination of these tools, including recycling and a releveraged transaction. And that was an enhancement to the company value of as much as 20% over those 10 years. So just to underscore that this can be very important to the company in terms of valuation. This next study was a case that is fairly typical. The ESOP went through its leveraged phase when the company was rather small, around 25, 30 employees. It had grown substantially in the last few years, but it had grown all after the ESOP stock had been allocated. So in this case, the company was now 85 employees or participants. 26 held over 75% of the benefits in the ESOP, the employer stock in the ESOP. So this was definitely an extreme example of a have-have-not situation. Some employees were opening account statements with over $1 million balances, and some were opening account statements with a few $1,000s of benefits. So the company wanted to change this dynamic. They wanted to create benefits for the lower paid employees and the newer employees. They wanted to do it in a way that didn't impair the value for the long-term employees. So we went through a number of scenarios and came up with some changes in the distribution policies, the allocation rules of the plan that basically allowed highly compensated employees with their agreement to cap the allocations of new shares to those employees. And we did it in a way with a leveraged transaction that wouldn't have any significant downward effect on the long-term employees' account balances. Essentially, it just created the renewal of these shares allocation on a basis that was much more fair to lower paid and new participants. It takes a fairly long time to take an approach like this, so it's something you want to think about ahead of time rather than trying to cure this after the fact. But in 15 years, the lowest one-third of employees in terms of compensation, we're going to move from having 4% of the company to more than 15%. The middle tier, the middle third, was going from 17% to just about 25%. And the group that held the majority of the shares were also some of the top paid people in the company. And they were going from about 78% of the company to about 60%. So you don't want to find yourself in this situation. It can take a long time to undo it, which is why this repurchase obligation funding is very critical. We're going to talk real briefly about ESOP termination. The basics are the board of directors can terminate the ESOP at any time. It's a unilateral decision. It results in full vesting of all the ESOP participants. And in some cases, if there's a sale of the company or a merger or some other corporate event, it may require pass-through voting. It may be a business decision. It may involve the sale of the company. It may involve the bankruptcy of the ESOP company. You want to think about a few items upon ESOP termination. How will the assets be distributed? Will it be a stock sale, an asset sale? Sometimes in the sale of a company there are earnouts or escrows. You have to be very careful about that and who has the right to hold those agreements or mechanisms. In some cases, you'll have to issue certificates for an earnout because otherwise it's a prohibited transaction. An earnout is essentially a contingency payment based on the experience of the company immediately after the sale. So if things go well, there's often a holdback, an escrow that allows a contingency payment to be made after the sale. You need to be careful about that in your ESOP termination. And then also there are timing issues, and once you terminate an ESOP, you generally need to distribute assets within a year. That can be extended to as much as 2 or more years. If you go through the IRS's ruling process, that's taking additional time and gives more time for the company to budget for the cash outflow. Are there assets to be distributed, cash or others, if it's a distressed sale? Sometimes the answer is no. After the company has settled its debt, there's nothing to be distributed to the ESOP participants. Recommend that you at least distribute the stock in those cases, stock certificates. Will there be liquidating distributions for the company if the company has entered into a plan of liquidation? And then in cases where there are no assets to either distribute or cover plan expenses, there are a couple of programs that give you some grace for the expenses involved in auditing the plan and filing the 5500 and those things. We're about out of time. I'll be around for the next 5 minutes to answer any questions you have. But thank you for joining us. Hopefully you found this to be a valuable presentation, and we'd be happy to forward the deck to anyone that would like it. Again, appreciate your time, and give us a call if you have any questions about anything we discussed today. I'll be on the line until 1:30, so thank you for joining us.
premiumbeat.com.